I'm the director of the AIFC Academy of Law, and welcome to this next segment of World Investors Week 2020. Welcome to all of our participants from Central Asia, Europe, Middle East, and across the globe. We are broadcasting here from actually various parts of the world. I'm in Nur Sultan, formerly known as Astana, and our distinguished speaker today is up in the UK near London. And welcome to all of you. We hope you're staying safe and well. And we're especially respectful that you continue to work constructively during these rather unusual times and continue to build your businesses and law firms in a way that is going to ultimately benefit global trade and certainly legal systems around the world. So today we have a very interesting and relevant topic called Debt Capital Markets in the AIFC, a checklist. And I'm going to go ahead and introduce today's speaker, but before we get into that, you know, earlier this year, the Academy of Law ran a series of webinars that we called In the Room Where It Happened. And basically, the speakers in that program were from the AIFC's Legal Advisory Council, as is today's speaker, Andrew Roberts. And we called that series The Room Where It Happened for a reason, and that's because this advisory council was really hand-selected and carefully selected based on the expertise, the knowledge, and the experience, perspective, and know-how of its members. And they were there in the beginning. This council put together the entire legal infrastructure at the AIFC. So we have the privilege and honor today of having as one of our guest speakers, Andrew Roberts, who was in the room where it all happened. Andrew specializes in debt capital markets. He works with issuers and underwriters in offerings of a wide range of debt and equity-linked securities. With substantial international experience, he has worked with clients in most major financial centers and many emerging markets. He also specializes in Islamic finance. His practice spans the full spectrum of debt capital markets products, including investment grade bonds, medium-term notes, commercial paper, sovereign and quasi-sovereign issues, emerging market issues, regulatory capital, liability management, equity-linked bonds, structured bonds, high-yield bonds, and sukuk. Andrew, that is quite a list. We're looking forward to your presentation. It's nice to see you, and welcome to today's event, Andrew.
Many thanks, David. That's very kind. I perhaps need to rework my short bio, but yes, I guess over the years there have been quite a few transactions in which I've worked on. I think I should just add also that the Legal Advisory Committee is much more focused around the review of the legislation and regulations which were being prepared by our colleagues at the AIFC. So it's more of a, not a drafting, but more of a review just to try and bring the international flavor to it to help facilitate the development and make sure that the issuance and people establishing the AIFC were able to benefit from that international experience. So shall I just crack on and upload the presentation that we're meant to be that we're going to be following through?
Yeah, go ahead, Andrew. We'll turn it over to you, and you can go ahead and take it away. Let me mention to the audience members that my colleague Almas behind the scenes will be encouraging you to send in your chat questions during the event. And then if time permits, at the end of Andrew's presentation, we're happy to do some interactive Q&A. So please feel free. And with that, yeah, Andrew, let me turn it over to you.
Sure. And if we can't sort of deal with the questions in the Q&A, more than happy to do follow-up responses as required. Thanks, David. Let me just get this screen up and running. Not going to work. So have we oh.
Great. Yep, we see that, Andrew. All good.
Yep. Sorry, but I should have perhaps started at the beginning, shouldn't I? Many thanks, David. And I echo your introduction. I really do hope everyone is well and working as best they can in these very unusual circumstances. And it does, in a way, seem a little bit odd, given the current circumstances, that we should be talking about bond issues and the like. However, I think what we all need to do is focus on what's going to happen next, and to that end, we are all going to be looking forward to some degree of normality, and we are going to need to look at financing of the re-emergence of the various economies around the world. So, hopefully this is a useful introduction to some of the issues around the issue of bonds in the AIFC and around the AIFC. It's actually been an interesting year this year, in that what we have seen is a very high level of issuance in the bond capital markets. Really what's been happening is the corporates have been accessing a lot of liquidity to try and shore up their balance sheets and ensure that they have plenty of cash available. And they've been taking advantage of the very lax monetary conditions with all of the liquidity which central banks around the world have been adding into the market. So we've actually had a very busy year of primary issuance, particularly in the investment grade market. So today I was going to provide looking to provide a very high level introduction to bond issues, some of the more practical aspects about bond issues, and doing it in a way which contrasts bond issues with a loan, on the basis that we quite often, a lot of people understand loans, they're very basic, a very bilateral relationship, and really trying to explain why bonds are perhaps a little bit different from loans, and then focus more on some of the things which over the years I've found useful in looking at new and emerging jurisdictions, and what are the checklists that you need to run through for a new jurisdiction, what works, what doesn't work, and then we'll just draw a few conclusions from that, and hopefully deal with a few Q&A. I must, to help tailor the presentation, we have a very short poll. I'd be grateful if Almost if you could just shoot around, and if we just see how that just to gauge the level of experience with which we're dealing with, because I don't want to bore everybody with completely unnecessary information. Interesting. Okay, so that's good. So then I will just crack on to the next slide. I think we can probably, should we end that poll, do you think? Should we end that? That's useful. So basically we've got a collection of people with some experience and a lot with others who have little or no experience. So I think the very high level summary is the real loan relationship. So what we're just sort of painting here is as I mentioned, the loan relationship is one which is at its very basic is the bilateral relationship between a bank lender and a borrower. Generally speaking, what we have are bankers with long-term direct relationships with a borrower, and that long-term relationship means that they tend to have a very good knowledge of the borrower's business, and they're in relatively regular contact with the borrower. The loan, as we'll touch on in a minute, is on balance sheet, and therefore the bank is very focused on its risk and its ongoing risk. Whilst there is some secondary sales, the loan is normally a capital cost to the bank, and therefore they're very focused on maintaining an ongoing relationship because they're locked in pretty much for the term of that loan. And then just to try and sort of set a scene of the difference, a bond relationship is usually much more remote from a borrower, particularly if we're looking at the investment grade market. And by investment grade, I mean investment grade by the rating agencies, typically one of Standard & Poor's, Moody's, or Fitch. The investors in a bond rely on those rating agencies to help them in their decision as to whether or not they're going to invest in the bond, and also their pricing levels. Bondholders are also looking, well, at least theoretically anyway, looking at the disclosure which is set out in a prospectus, which is prepared for the issue of bonds and for a listing of those bonds. There is, generally speaking, very limited, or in fact no direct contact between investment grade bondholders and an issuer. Obviously, if you move to the high yield market, which is sub-investment grade, there tends to be much more direct relationship between bondholders and an issuer. And if you move into the private placement market, very much a direct relationship. But what we're focusing on in this presentation is much more the investment grade market and their little or no involvement. The banks or the managers or underwriters who are arranging a bond issue are looking to on-sell all of the bonds that have been issued, and therefore they only have, if you like, an intermediary risk. They don't have a balance sheet cost unless they haven't sold their bonds, and so that means that they're not necessarily going to have an ongoing long-term relationship with an issuer. From a bondholder perspective, what they're very interested in is transferability and ability to sell or hold their decision. So what I'm going to do in the next few slides is just really run through a few bullet points which, if you like, juxtapose or contrast the position between bonds and loans. I hope I'm going to do that. If I can get to the next slide. Oh, that's my thing not working. Ah, here we go. So, bond issue, as I mentioned, investment grade bond issue, which is going to also have issue listed bonds, is going to involve the preparation of a prospectus. And I mentioned 144A here with a question mark. There's the Reg S bond market and the 144A bond market. The Reg S bond market is really focused on sales of securities outside the United States. 144A allows limited sales for bonds into the United States to qualified institutional buyers. This prospectus can be a big document. Even some of the documents listed on the AIX, you'll see run into the hundreds of pages. And contain obviously a lot of financial information in relation to an issuer, as well as quite detailed information around the risk factors and the description of their business, sets out the terms and conditions, a lot of information. By contrast, your bank, your loan, average loan, syndicated or bilateral is nothing. Syndicated loan, depending on the level of syndication, may involve the preparation of an information memorandum by the banks who are arranging the loan. No real involvement of external counsel. It's just really a pulling together of information in relation to a borrower. So quite a different set of disclosure or information documents, which reflect, as I mentioned before, the bank debt, you shouldn't need a detailed information memorandum because the bankers should know the credit, whereas the prospectus is, if you like, introducing an issuer to the market. That prospectus is generally being used for the purposes of a listing and a listing on an exchange, the AIX, or anywhere else. Plenty of venues for listing. By contrast, obviously, bank debt with a loan, no listing, and indeed there can well be confidentiality undertakings where a recipient is being given information on a confidential basis. So very different level of disclosure and publicity around that disclosure document. The bonds, the arrangers of the bond issue, the underwriters, lead managers, arrangers, the various terms that are used to describe the banks who assist an issuer in arranging a bond issue, that their relationship is, as I mentioned before, it's that short-term helping an issuer structure the bond issue, prepare the prospectus, obtain the listing, then go to market. And then generally speaking, their job is done. Yes, there's some aftermarket ensuring sort of price stability, and there can be some aftermarket provision of liquidity in trading the bonds subsequently, but there's no obligation for the banks who were the original underwriters to actually stay involved with an issuer and carry on with any kind of monitoring or take any responsibility for the issuer and what happens after the issue of the bonds. Somewhat by contrast, the bankers, who obviously are the lead arrangers on a syndicated deal or just the lenders on a bilateral deal, this loan is on their balance sheet. They have a risk on that loan. They are therefore much more involved in the monitoring and stay involved with the issuer and want to know what's going on and be involved with any announcements that are coming up. Bonds, going back to the next line, at least theoretically, multiple investors. So many bondholders. We're talking about large numbers for the investment grade market with high denomination securities. We're looking at professional investors, but still looking at a wide range of funds, insurance company investors, running into the tens, hundreds of investors. What I'm focusing on here generally is actually the professional bond market. We're not looking at retail bonds. Retail bonds can involve the sale of bonds to many small retail investors, and there you can have hundreds, if not thousands, of investors. What we're focused here is that the large, I'd say over 95% of the international bond markets are really focused on the professional investors, where retail investors actually invest via bond funds into these types of bond issues. So we're looking at a broadly held bond, lots of investors. You don't necessarily know who they are because they're holding through accounts and clearing systems. So we know that an issuer doesn't really know who their bondholders are. They may well know which accounts were offered bonds as part of the initial syndication, but after the initial purchase, bondholders are free to buy and sell and trade. So you do not know, an issuer does not know actually who ends up holding their bonds. Obviously, with bank debt, much more straightforward. It's either bilateral or syndicated, and quite clearly the issuer and the banks involved know each other and know exactly who holds what and what their exposure is. rating requirement is part of, as I mentioned before, the slightly more arm's length relationship between a bondholder and the issuer. Ratings are, for investment grade anyway, a requirement, and the higher the rating, obviously, the lower the interest cost, the lower the risk. So your risk, price of the debt and the level of risk is obviously conversely or inversely related. So as part of an issuer, for a debut issuer, one of the processes that's going to be involved is the engagement of rating advisors and obtaining a rating. And that can be quite a time-consuming process leading up to beginning the bond issue process itself. Obviously, given everything we've just been talking about, for the bank relationship, no ratings required. The banks have done their own credit. They are very happy with an issuer. They may not be happy, but they will be prepared to lend. They don't need a third party coming in and providing a rating. Comfort letters, these are letters provided by the auditors to the issuer, and they confirm that the financial information set out in the prospectus has been correctly taken from the audited financial statements. They also provide bring down comfort that from the last audited financial statements, the auditors, having done a certain level of work in relation to reviewing management accounts and also looking at discussions with senior management, that nothing has happened subsequent to the last published audited financial information which bondholders or which the managers or should be aware of and or should be disclosed in the prospectus. Again, with the bank debt, no comfort letters required. There is no need for the additional comfort of an auditor. The banks have the relationship. So then, on an ongoing basis, that sort of deals with, if you like, the initial issuance of the bonds. We're looking here at the ongoing relationship. As I mentioned before, the bonds, so long as the syndication and sale of the bonds has been successful, the arrangers or underwriters don't have any bonds on their balance sheet, unless, of course, they want to. But they have looked to offload all of their bonds to some of the bond funds, whether they be emerging market bond funds or just pension funds looking for long-term assets. The arrangers have hopefully removed that risk off their balance sheet. Bank debt, classically, there can be syndication and secondary sales of loans, but the bank debt is an on-balance sheet cost. And as we all know, I'm sure we've touched on in other presentations, the regulatory capital requirements imposed on banks mean that any risk asset on their balance sheet is a cost to them, and that they have to have or allocate capital against that balance sheet cost. So there's an ongoing balance sheet cost for a bank, which again is reflected in the pricing of bank debt as opposed to bond debt. Bond debt, and a lot of the comments we're making here are, of course, very, very general, but generally speaking, one of the reasons why issuers access the bond market is for longer maturities. Whilst banks are happy to lend, they are generally lending at the shorter end of the maturity profile, providing liquidity, whereas the bond financing tends to be a longer term financing, 5 to 7 years being obviously the most common. But we're seeing a lot of transactions pushing out, depending on the market and depending on the credit and depending on the appetite. We're seeing a lot of 20, 30, 40, 50-year bond issues. Again, generalizing, a lot of the bonds being issued at the moment are fixed rate. You can, of course, have a multitude of interest variations on a bond issue, ranging from zero coupon and indeed negative coupon, which is such an interesting concept. Where you have the bonds being issued not at 100%, but they're issued at a price of a premium to the current price of, say, they're issued at 101 or 102, and with an interest rate of near zero. So the actual yield on your bond is negative, which is what's happening in some of the more higher rated credits in the euro market at the moment. So you can have zero coupon, you can have floating rate notes, obviously, although they're not particularly common in the market at the moment. We are seeing vast amounts of fixed rate issuance. There's a multitude of other ones, variable rate. You can have it linked to indices, you can have inflation linked, a whole lot of variations. The bank debt, by contrast, is generally speaking floating rate. Obviously, you can get term loans with fixed cost, but your classic bank loan and loan facilities are based at a floating rate, with a margin over LIBOR or equivalent, or obviously the new risk-free rates, which are all going to be, actually are here now, but will be compulsory as of 2021. The other feature of bonds, generally speaking, again, because you can have variations on this theme, are that when you issue your bond, all of your proceeds are received on day one. By contrast, a loan facility can be established, and you can draw down either when needed or against certain conditions around. If you're constructing or using a loan finance for a project, you can have drawdowns against certain certification as to completion of a particular asset which is being constructed. When I say bond issues, always proceeds on issue. Obviously, there are lots of variations around that. We've seen a number of bond issues now being used in project financing, where you can have staggered drawdowns of bond issues. But generally speaking, it's all the money upfront. Call options or optionality around early redemption is relatively uncommon in bonds, and it can cost you. Again, the theory of your investors, or the theory behind the investment market for bonds, is that an investor is committing for that 5-7 year term, and they've allocated that money, and they're match funding that with something else. They've got an asset or they've got a liability somewhere, so they've bought that bond to match that liability. They really do not like call options, which mean they can get their money back, or their money can be paid back early. It doesn't really fit well with the match funding of a bond issue. Bank debt, by contrast, particularly because of the fact it's floating rate, there is repayment flexibility, where you can discuss with your lenders around prepaying on the next interest payment date. Obviously, with any kind of call option on a bond issue, if it's fixed rate, there is a real concern from investors that obviously when rates increase, the bond or decrease, the bond issuer will seek to redeem and borrow at a cheaper rate. So we tend to see make-whole redemption formula if and when there is any kind of early repayment. Another feature of the bond issuance as opposed to loans is there is a liability around that prospectus which was prepared. A bondholder is required to represent that all the information that is provided in that disclosure document is accurate and not misleading, and bondholders are able to sue the issuer if in fact they are able to establish that the information provided in the prospectus was misleading and that they purchase those bonds on the basis of that misleading information. Obviously, that doesn't really apply in a loan situation. There's no documents, less liability on the lenders. It's a direct relationship. Picking up on the theme we mentioned earlier on multiple investors, there is a broad investor base who are looking to invest in bonds. Some of you may have heard of the concept of roadshows. What is happening there is that now all the roadshows, of course, are virtual in current circumstances, but generally speaking, a debut issuer or a relatively new issuer to the bond markets will need to go on the road, and that means going to visit investors, New York, London, across Europe, potentially Middle East, and into Hong Kong, Singapore. So yeah, depending on what type of security and what type of credit, there's an attempt to sell bonds to a very broad investor base. Obviously, the banks who are lending, or obviously there's no need to do a big roadshow, obviously, because the lenders are aware of credit and aware of who the borrower is. So there's no need for a big roadshow. There is an increasing number of funds, private equity funds, that are looking to invest into loans in the secondary market. But again, they tend to not have a direct involvement in discussions with a borrower under a loan. They are looking simply to extend their exposure to either industry sectors or to a particular borrower via buying a loan or a portion of a loan in the secondary market. But relatively limited investor base by comparison to the bond market, which will have a very, very broad, potentially very broad market. One of the things underpinning that broad market is liquidity. One of the benefits for bondholders is that they have a security which is transferable, and they want or would like to have and will pay for, and when I say investors pay for, that means accepting a potentially lower rate. They will pay for the ability to sell out of the bond, and that sale may be because they don't like the credit anymore, maybe because they have too much exposure to that particular issuer or to that particular sector. They may wish to reduce their exposure, therefore sell the bond. And there's a lot of talk around illiquidity premium, where you have either a small bond or a bond with limited transferability and limited size. And you'll perhaps hear reference to benchmark size, which in the dollar markets tends to mean a minimum of 250 million US, 500 million being even better, and to provide a liquid market where there is an ability to trade out if you want to, if a bondholder wants to. By contrast, the loan market, whilst there is some liquidity, as I mentioned, with secondary market sales, relatively illiquid. It's not easy. It's not a transparent market. It's not always straightforward. There's a lot of secondary market activity, but it's, by contrast to the bond market, relatively illiquid. The bond market fees payable by an issuer, generally one-time fees that are payable on the issue as an underwriting fee. And once that's paid, obviously there are ongoing fees that may be payable to the agents who are responsible for the ongoing payment of coupons and principal on the bonds, and a trustee if a trustee is involved. But generally one-time fees, whereas with bank debt, potentially ongoing fee arrangements for facilities where the banks are agreeing to provide funding if and when an issuer wants to draw down under their facility. So just wrap up a few of these points. Bonds, because of that remote nature and because of the rating agencies and because of the ability to, or as a consequence of that ability to sell, I use the phrase less interference from investors. It really means there's not really an issuer doesn't really have to concern itself with providing any additional information to investors, and they're not particularly closely involved in the ongoing business of the issuer. That said, investors, of course, will be very keen on monitoring an issuer and ensuring that the credit rating remains the same as issuance as that on issuance. Bank debt, obviously, there's got to be a lot of ongoing involvement from the lenders, as we've mentioned before. Going back to the bonds, obviously, if there are covenants, financial covenants, or things like a negative pledge, they tend to be self-certifying. A bond, the issuer will confirm once a year that it's in compliance with its covenants. The bank debt, continuous monitoring, and the bankers are very involved in ensuring compliance with the covenants. And then financial covenants are obviously not often seen in the investment grade market, but there's an occurrence versus a maintenance basis there, which is much more with the bank lenders on a loan are going to be all over those financial covenants, and there's continuous compliance, and a borrower will need to be contacting its bankers under a loan in the event that any of the financial covenants are getting close to their covenant levels. The reasons for the self-certification and the less interference from the bondholders and different levels of covenant protection in a bond being slightly looser than those for a loan, generally speaking. Is it getting consent from a bondholder to, or bondholders to, any waiver or modification to the terms and conditions of bonds? It's relatively difficult. Obviously, it can be done, and all bond issue conditions have built-in provisions for meetings of bondholders, or nowadays much more efficient procedures for voting through the clearing systems. But it's a relatively time-consuming process, and quite often fees have to be payable just to get bondholders to engage with the thought process of what they're being asked to do by way of a waiver of a condition, or consent to whatever changes an issuer might want to have to their bonds due to changes, mistakes, errors, whatever might be required to be consented to. Of course, by contrast, reflecting all that we've been talking about, where a lender has ongoing involvement with a borrower, it's a lot easier to go to your banker and obtain consent to some kind of modification or waiver. So that is one of the real advantages of your lending relationship, and that it's a much closer relationship. What we're trying to portray here is a bonds of more arm's length, and here is one of the real advantages of your loan financing, and that you have a direct relationship with your banker, and a treasurer or CFO of a company can easily pick up the phone and talk directly to its bankers and discuss what consents may or not be required, and you can obtain a bank waivers very, very quickly. Bondholder consents, slightly more difficult. Bonds, the investment grade bonds tend to contain very few optionality about early prepayment. One of the features which are quite common in investment grade bonds for corporates is a put option where there has been a change of control, which is combined with a rating downgrade. These put options became a feature with the advent of leverage buyouts, and what was happening is that bonds were being bought by either by way of a management buyout or just a leveraged buyout, and the credit on the bond was being reduced or destroyed because of high levels of leverage, and therefore the protection built into investment grade bonds does tend to come around with a change of control. So if there is a change of control, which then results in a rating downgrade, then the bondholder has the option to go back to the issuer and say, no, please repay my bonds. The bank debt, generally speaking, it's a mandatory prepayment on a change of control or any other illegality or event of default, which we'll come on to in a minute. But again, the bank debt, any kind of change of control, normally speaking, a purchaser who is buying a company will already have bank finance arranged, so it's not really a major problem for there to be a mandatory prepayment. The events of default in a bond issue have what I describe here as a degree of rigidity to them, in the sense that they're not really able to be too flexible, because you can't go back to bondholders and have a conversation with them about what kind of flexibility do you need in relation to a particular event of default. And you won't see, or very rarely in investment grade market, will you see an event of default which is absolutely standard in the loan agreement, with things like a material adverse change. Because the difficulty you have with material adverse change is what does that actually mean? Is it material? Is it adverse? Etc. etc. In a loan relationship, what the lenders want to do, the banks want to do, is have that discussion with a borrower around anything which is material, and that sort of works in a bilateral or just a very limited number of parties type of discussion. Can't really work in event of default with your multiple investors. So therefore, the event of default in investment grade bond tend to have rigid, very objective thresholds. They cross default specified amount, insolvency, but quite objective events of default. Amendments, as we touched on, relatively difficult. Bank debt amendments much easier to obtain. Transferability, the key, it is a key feature for bonds that they are transferable. Most investment grade bond, all investment grade bond issues will be traded through the international clearing systems, Euroclear and Clearstream, and that investors, bondholders will hold either directly if they're very large bond investors and have their own Euroclear and Clearstream accounts. Otherwise, they'll hold through a network of custodians. And one of the difficulties which arises in obtaining a bondholder consent is actually finding the bondholder. The difficulty can actually be that there'll be multiple custodians before you get to the actual bondholder, who's then going to be required to consent or otherwise to any kind of waiver. Bank debt transferability can in fact sometimes require a borrower consent, but it's just not really a major feature of loans that they are fully transferable. As I mentioned, there is an increased secondary market, but liquidity is not a major issue in the context of a loan market. Call options I touched on before, very unusual in an investment grade bond. Unusual and expensive. They will have to be called at a redemption amount together with a margin over comparable benchmark government securities. the one exception is a call option if withholding tax is imposed. The market approach here is that an issuer of bonds is obliged to gross up for any withholding tax which might be imposed on interest payments under the bonds. And the quid pro quo for that is that if a issuer is obliged to gross up because there has been some form of change in the withholding tax regime in the jurisdiction of the issuer, that they will have the option to call for the bonds to be redeemed early so as to avoid the future payment of withholding tax. And that is just one of the accepted risk sharing relationships in the bond structure. The bank debt, interestingly, has an ability to individual borrowers, individual lenders, sorry, can call for the borrower to gross up for any tax which may be imposed on them, and that's tax as well as any increased costs which may be imposed on a particular bank. A borrower's recourse is to actually prepay or repay that particular bank. But in a way, you can see the contrast there with a bond market where that's just not going to be possible. You can't identify particular bondholders, so therefore there's no individual rights to prepay bondholders. So that's hopefully given a very high-level introduction to bonds and some of the relationships and differences between bonds and loans, to try and get a better understanding of how bonds operate and why things are a bit different with bonds as opposed to loans. This checklist is a checklist which I've used for variations of this checklist I've used for many years in approaching bond issuance in new or relatively new jurisdictions, or new to me jurisdictions. And it really is just to make sure that there are no traps or issues which might come up in the process of a bond issuance to either delay the timetable for issuance or cause embarrassment or difficulty for both banks who are arranging the bond issue either before the bond is issued, or even worse, problems which occur after the issuance. So taking these points through, the internal approvals really touch on the approvals which a issuer of bonds needs to have for its issuance. And here we're focused, generally speaking, on a corporate. Obviously, there's one of the big sector of issuance in the international debt capital markets are sovereign and quasi-sovereign issuers. They have different issues around their internal approval processes, which we haven't really gone into here. It's some countries require budgetary consent, etc. But that's a degree of complication which we won't go into here. Really focused here on corporates and how a corporate would authorize the issue of bonds. And generally speaking, they will always need a board resolution. Some jurisdictions also require shareholders to provide a approval to the issuance of bonds. And what really I'm aiming for in this checklist is really just to leave everyone comfortable. Maybe that's not the right word, but assured that the AIFC, through its structure, its regulations, its laws, has dealt with all of these issues which you're going to touch on in this checklist, and there aren't any issues which you would expect to in any way hinder the issuance of bonds in the AIFC. An AIFC company does not need a shareholder approval to issue bonds. Obviously, if you're talking about a company which is incorporated outside the AIFC and looking to issue through the AIFC and list on the AIX, you'll need to check exactly what their requirements are for approving a bond issue. A Kazakhstan company, obviously, for example, won't need a shareholder approval, but there are jurisdictions where shareholder approval may be required. The other internal approval trap or issue which can be a problem are borrowing restrictions. In some jurisdictions, you'll have borrowing restrictions embedded in the constitutional documents of an issuer, or there might be some form of shareholder agreement which restricts the issuance of debt by an issuer. Again, AIFC companies don't have, or won't, highly unlikely they will have any of these types of restrictions. Any other companies, you'll need to check to make sure that there are no restrictions embedded in the constitutional documents. By external approvals, what I'm focused on there is really consents from a regulator or some third external party. Again, AIFC, not an issue, no consent required. Outside the AIFC, most jurisdictions, well, external consents are rarely required. Obviously, with some, particularly in the banking sector, banks may require an approval from their regulator. There are other jurisdictions where consent may be required from the securities regulator or or whatever sector it might be. Again, AIFC, no such restrictions. There are jurisdictions which also have restrictions around the use of proceeds. You can only issue bonds to do certain things. Again, AIFC has none of these restrictions. The other feature which we find difficult in some jurisdictions is the use of medium-term note programs, which set up a framework for the issuance of bonds from time to time. And what can be very frustrating in certain jurisdictions is you will obtain a consent for the initial establishment of the program and the initial drawdown of that program, but then you need to go back and get another consent for each issue under that program. Again, good news, AIFC, no such restrictions. Exchange controls, again, not really an issue in Kazakhstan and not an issue in AIFC, but it's again one you need to check in any type of new jurisdiction. Are there any restrictions in the availability of the funding? Because what we're looking for is an issuer in country X needs to be able to remit the interest and principal payments out of country X to its international investors. Are there any exchange controls which might inhibit that, or any kind of shortage of hard currency if you're talking about a relatively weak emerging market currency? Again, not an issue in Kazakhstan. Taxes obviously are a very important part of a bond issue. You don't want to have any withholding tax imposed on interest payments under bonds. Obviously, a number of jurisdictions do have withholding taxes, and you can issue subject to withholding tax. It gets a bit messy, but it can be done. Again, AIFC no withholding tax, and for a Kazakhstan company issuing bonds listed on the AIX, Again, no issue with withholding tax there. As I mentioned before, a lot of work goes in at the outset of a bond issue transaction to ensure that interest payments can be made free of withholding tax, and an issuer tends to have an ability to call their bonds if there's been some change of law, which means that tax is subsequently imposed. Again, issue taxes, some jurisdictions do have issue taxes. These are problematic. AIFC, of course, does not. Transfers, tax on a transfer, some kind of stamp duty on, or transfer tax on subsequent liquidity. Again, touching on one of the points we mentioned earlier around the need for liquidity and transferability. Any kind of tax on transfer or preventing the transfer of securities is a real impediment to that whole issue of liquidity and transferability. So it's important to ensure that there are no taxes, or those taxes are waived, or an issuer is liable to pay the taxes rather than a bondholder. But again, AIFC, no such issue. Stamp duty payable on any court filings. Again, there are some real issues in some jurisdictions where if you do have to take your bond documentation into the country and into those countries' courts, you will have to pay an ad valorem stamp duty on those court documents, which can be very expensive and can be a real impediment to enforceability, and is quite a major impediment to a bond issue, and adds to the risk premium which might be payable and reflected in a higher coupon. AIFC, Kazakhstan, no such issue. Looking at the mechanics of an issue and just sort of some of the bare bones, again, AIFC, you can issue in bearer form, registered form, or actually dematerialized. So there's no real issues around or to stop you from doing whatever you want by way of the type of security which you wish to issue. Again, also clearing systems, no issues around the use of the main international clearing systems, Euroclear and Clearstream. Selling restrictions, again, if we're focused here on investment grade bonds which are being sold to professional investors, there will be restrictions in most jurisdictions on the sale of bonds to retail investors, which either is prohibited or will require additional disclosure. However, if we're looking at the professionals market, the AIFC and Kazakhstan generally allows the sale of bonds to the professional investor market, which is pretty much the same globally. So long as you're focused on the professionals market, sales are able to be, or bonds are able to be made. Enforceability, it's always it's an argument which actually should be, enforceability should always be at the first issue. How can I get my money back? What do I have to do to get my money back if the issuer doesn't pay? And it is obviously a really key issue in looking at any new jurisdiction. It's all very well having these other, checking the box on all these other issues, but if you can't get your money back, or it's incredibly difficult to get your money back, that's not a good thing. So in enforceability, you've got a number of issues which you need to look at in a particular jurisdiction. And the first one is really just checking what is the appropriate dispute resolution mechanics. The general traditional way of getting your money back on a loan or a bond is you use the court system. Some jurisdictions, it is much more efficient due to, the point is you don't want to have two hearings around the same non-payment of a debt, if you like. You don't want to have a discussion in a court, or sorry, a case in a court around non-payment or breach of covenant, and then have to go to the jurisdiction of the issuer and have a complete rehearing what you want to do is have a judgment from your chosen dispute resolution forum, and you want to be able to take that judgment into the jurisdiction of the issuer and enforce it without need for a rehearing. So in some jurisdictions, having an enforcement of a judgment of an offshore court is a problem. Some jurisdictions it's fine. So therefore, what we are seeing in a number of bond issues is the choice of dispute resolution as arbitration, because many countries have signed up to the New York Convention on the enforcement of arbitral awards, and therefore it is much easier to have an arbitration around a bond issue default or dispute under a bond, and therefore take that arbitral award into the relevant jurisdiction and enforce it. Arbitration is actually it works in the context of a bond issue, obviously, because it's used quite often. It isn't really the certainly my preferred dispute resolution mechanism, simply because it's not particularly complicated. A bond issue dispute, it's generally has somebody paid or has they not paid. You don't need to arbitrate that. But we have issued bonds across the globe with arbitration as being the dispute resolution mechanism, simply to ensure that we have an award which is enforceable. And where do you want to enforce? Obviously, what you want to do is identify where are the assets for your particular issuer, and can you enforce against those assets? Now, of course, the huge advantage of the AIFC with its state-of-the-art dispute resolution mechanics with the court and the arbitration center, you have a very efficient mechanism for both of those fora, and a judgment from one of them or an award from the arbitration center is able to be enforced in a court outside the AIFC in Kazakhstan. So it's an extremely efficient a way of ensuring you have access to a very, if you like, state-of-the-art dispute resolution forum, which has been established to facilitate rapid dispute resolution. Having a judgment or an award from an AIFC court or arbitration center is a real plus in the use of the AIFC. I've left this last, but of course, every jurisdiction you go to, the first thing you look for is are there precedents? Has there actually been an issue? What can we copy? And that is obviously the case with AIFC. And the great news for any bankers, lawyers, issuers looking to issue either from an AIFC company or through the AIFC, there are already quite a long list of issuers who've already been there. They've broken the ground. They have the disclosure document, which has already been prepared. The likes of Sakent Gas, Ferro Alloy, Freedom Holding, Alten, just to name a few. The huge advantage is that anyone coming to market now is able to look at and compare and contrast, and not only looking at the rules, of course, but also have a look at how these rules have been addressed in public documents. So it's if you like, it's a huge comfort to both investors, bankers, lawyers. Once you have some precedent out there, it just becomes much easier, and it's like a snowball. it's a real plus. And as you build up a body of bankers and law firms who are experienced in the issue and using the AIX, it just becomes a much more straightforward process. And also, what is really really important is that your investor base, these professional investors, become more and more used to using the AIFC as a dispute resolution forum, and the AIX, that it just becomes a much more comfortable for them. They don't have to spend as much research. Is this okay? What do I have to charge for this extra risk? It reduces the price of the bonds which you can issue through the AIFC. So the conclusions have sort of drawn here really are pretty obvious from what we've been talking about, and that AIFC has constructed a world-class financial centre, and there really are no impediments to the issue of debt securities. The mechanics are clearly set out in the market rules. The choice of governing law is between English law and AIFC law has no real effect on the terms or on the enforceability of contracts. You can have either governing law, and you'll end up in pretty much the same position, which is quite a plus. Most jurisdictions, there are all manner of advantages for using an international law, but AIFC, which of course has been carefully crafted to facilitate the issuance of debt and make it as easy as possible. As I touched on, the use of AIFC and the AIFC law and the dispute resolution structure of the courts and the arbitration centre is a real plus, and it is the obvious choice for dispute resolution for issuers in AIFC and Kazakhstan more broadly. I hope that's been useful as just an introduction to bonds and a introduction to the AIFC from a practitioner's point of view. It's always a good way of oh my God, I've gone over my time. I'm sorry, David.
No, not a problem at all, Andrew. It was very informative and relevant. And to our audience, think in terms of CFOs of companies making corporate finance decisions about how to raise money. And they have a couple of different options when it comes to debt. And Andrew went through the pros and cons of the different types of issuances. And that's extraordinarily helpful from both a legal and a business decision-making standpoint. So Andrew, thank you for that. Fabulous. We did have a few questions come in. Andrew, are you okay for a couple questions?
Sure. Apologies, David, but I did say that my talk was a lot shorter, but when you said we could go a bit longer, I did dwell a bit longer on the points that I wasn't going to dwell on, so I hadn't been focused on the time, so apologies for running over.
Not a problem at all. The more the better. It was excellent information. Almas, why don't you go ahead and read Andrew the first question, and maybe we'll try to handle a couple of them that have come in. Go ahead, Almas.
Okay, thank you, David. We have a few questions so far. So considering the timing, I propose to introduce two of them. The first question is, how can debt capital markets help companies survive the COVID-19 crisis? How COVID-19 affected AIFC debt capital markets?
What we are seeing with COVID response, debt capital markets have been active in helping the COVID response. As I mentioned right at the outset, there's been quite a high level of issuance where corporates have been borrowing effectively as much as they can to ensure that they have cash reserves to handle any of the uncertainty which is arising as a consequence of COVID. What we are actively looking at, or many market participants are looking at, is additional COVID financing. Again, we have a global environment of extremely low interest rates, driven in part by the excess liquidity provided by central banks, and one of the structures which I'm looking at the moment are bond issues for all kinds of entities who wouldn't normally come to the bond capital markets. We're talking about theatres, sports teams or sports associations, being able to provide long-term funding to help them over this period of uncertainty for the COVID period. So actually the debt capital markets hopefully are going to do their part in providing cash for companies and also countries. There's a lot of work going on with providing liquidity for for countries to help them tide over this period of reduced income, reduced tax revenues, whilst having more obligations to provide funding to their own countries. So a big role for debt capital markets to play, and hopefully they will. Was there another question?
Yes, thank you. The second question is how we can reduce the risks related to issuance of debts on debt capital markets. What tools we can use for that purpose?
It's reducing risk. I think this applies to excuse me. It applies to both debt capital markets and also loan markets. The factors which scare investors, and if you have investors being scared or worried, that's going to cost you more money. So how do we package up an issuer to allay those fears or concerns that a investor might have, and how you do that is there's a range of factors. You ensure that any particular issuer coming to market has a track record of audited financial information provided by or audited by a reputable audit firm. Whilst there's been all kinds of issues around the quality of audits and problems which have arisen on audits, it still is a very important part of the issuance process and giving comfort to investors that these are audited financial statements, and you've got 2, 3, 4, 5 years of financial statements showing numbers, performance of a company over that period. The longer that history, the stability of the revenue, or preferably not even stable, preferably rising revenues and profitability, that reduces risk and ensures investors are happier with the credit. Other factors involved are, if you like, transparency of the issuer, clarity of its story. I mean, the bankers will always talk about the story, and you need to have in your prospectus when you're describing an issuer a description of its business, its sector, how that sector fits within its country or region or globally, what its prospects are, and the description around its management. How is it? Who are the management? The structures around, comfort that it has proper, good management in place with transparent management requirements, risk committees, audit committees, the processes in place to assess risk. Other things, we touched on it before, enforceability. If you have a process which enables you as an investor, if something does go wrong, fingers crossed, obviously nothing does go wrong, but if something does go wrong, if you're able to access the issuer and obtain a judgment against the issuer and potentially enforce your debt, the quicker the better. And the clearer the enforcement mechanism, the less risk, if you like, and the less risk means it's cheaper. If you're in a jurisdiction where it's going to take you years, if ever, to enforce, that's reflected in a higher coupon, because investors, when they're looking at that particular risk, are going to want to be paid more to take on the risk of enforcement. Those are just a few items. I'm sure there's plenty of others out there, but those are the few just that occur to spring to mind.
Okay, thank you, Mr. Roberts. Taking into account that we are out of time, I propose to finish. And for other guests, we can say that if you send your questions to our email, we will be pleased to answer by email. Thank you.
Thank you very much.
Excellent. Thank you, Andrew, again. Fabulous presentation. We really appreciated your time today. And to all of our guests, stay safe, and thank you for attending today's event. Bye-bye, everybody.
Many thanks. Thanks, David. Cheers. All the best. Thanks so much.
Bye-bye, Andrew.
Bye.